Hey everyone, if you're invested in dividend ETFs or you're curious about how funds like SCHD operate behind the scenes, today's video is going to be incredibly useful. We're diving deep into SCHD's annual reconstitution, explaining exactly how it works, what stocks are likely to be removed or added in 2026, and what this means for your dividend income. I'll break this down step by step. So even if you're new to dividend ETFs, you'll walk away with a clear understanding of the rules, the strategies, and the likely outcomes. Let's get started. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. To begin, it helps to understand how SCHD, or the Schwab U.S. Dividend Equity ETF, selects and maintains its holdings. SCHD follows the Dow Jones U.S. Dividend 100 Index, which is rebalanced annually, usually every March. This rebalancing is not random or arbitrary. It follows a strict set of criteria designed to focus on stability, reliability, and profitability. The first rule is about dividend history. A company must have paid dividends for at least 10 consecutive years. That's a hard cutoff, no exceptions. Any younger company or any firm that has cut or suspended its dividend within the past decade automatically fails this requirement. This is why you won't see high-growth tech companies dominating SCHD, even if they start paying dividends today. The ETF prioritizes consistency over hype. The second major factor is cash flow relative to dividends. SCHD wants companies that can sustain their payouts without jeopardizing their financial health. If a company is paying out more than it earns, say 150% of its earnings as dividends, that is a warning sign. Such a stock will not make it into the index. The fund looks for dividend sustainability, not just high yields. Third, SCHD evaluates return on equity, ROE. This metric tells us how efficiently a company uses its shareholders' equity to generate profit. By focusing on ROE, SCHD ensures that only companies with strong fundamentals and solid profitability make it onto the list. Simply paying a dividend isn't enough. The company has to be financially sound. The fourth and final key criterion relates to the dividend yield itself. A yield that's too low might indicate that the stock isn't producing meaningful income for shareholders, while a yield that's unusually high, say over 10%, can signal trouble. Extremely high yields often come with risks, such as declining stock prices or unsustainable payouts. Only stocks with yields in a reasonable middle range generally pass this screen. Once all these checks are complete, eligible companies are ranked, and the top 100 are included in the index. SCHD then holds these 100 stocks, weighted based on market capitalization and dividend yield, until the next annual reconstitution. Here's where things get interesting for investors. When SCHD removes a stock, it must sell millions of shares simultaneously. Conversely, when a new stock is added, the fund has to buy millions of shares. These actions can create short-term price movements, especially for smaller companies within the index. Understanding these dynamics helps investors predict which stocks might be removed or added, long before the official announcement. By looking at dividend history, cash flow, ROE, and yield trends through early 2026, we can make educated guesses about the likely changes. Let's start with the stocks that could be removed from SCHD in the upcoming reconstitution. Energy companies are a common target for removals. While early 2025 saw strong oil and gas prices, the sector weakened considerably in the latter half of the year. Any SCHD energy stock that reduced dividends or saw its cash flow coverage fall below acceptable levels is at risk. Investors should pay close attention to these companies because removal often follows periods of declining financial metrics rather than sudden surprises. Financials have a significant presence in SCHD, but any bank or financial institution with declining ROE or weakening dividend coverage could be removed. Smaller regional banks faced particular challenges in 2025, so they are more likely candidates for exclusion than larger, well-capitalized institutions. Any stock in the bottom 25% of dividend yield within the index is automatically at risk. If the total return isn't exceptional, these low-yielding companies may get replaced by better-performing peers. Historically, SCHD removes roughly 10 to 15 stocks each year during reconstitution. For 2026, removals are expected to be concentrated in energy and financials. While we can't name specific companies with absolute certainty, looking at 2025 performance metrics gives a strong indication of which ones might be cut. On the other side, let's talk about potential additions. Healthcare stocks are usually the top candidates for inclusion. Pharmaceutical and healthcare firms that increased dividends in 2025 and meet the 10-year payout requirement, along with strong ROE and cash flow, are prime targets. Industrials and consumer staples with robust dividend metrics could also be added. These sectors tend to have stable cash flows and consistent dividend growth, making them attractive to SCHD's methodology. It's worth noting that tech stocks face a barrier due to the 10-year dividend history requirement, so additions are more likely in sectors with established dividend records. If healthcare replaces energy, we could see energy's allocation drop from roughly 20% of the fund to about 17–18%, while healthcare rises to around 18–19%. These shifts slightly impact diversification and risk within the portfolio. Now, the big question: how will the reconstitution affect your dividend income? Historically, short-term changes to dividend income are minor, often neutral or slightly positive. If SCHD swaps a low-yielding stock for one with a higher yield, your current income rises immediately. For example, replacing a 2.5% yielder with a 4% yielder gives your portfolio a small income boost. However, long-term dividend growth is more important than immediate yield. A stock yielding 3% today but growing dividends 8% annually is far more valuable than a stock yielding 3.2% but only growing at 2%. Healthcare additions often bring strong dividend growth, typically 6–10% annually, while energy stocks can have uneven growth due to commodity price volatility. Let's put this in perspective. With $100,000 invested at a 3.63% yield, you earn about $3,630 per year, or roughly $302 per month. If the yield rises modestly to 3.7%, monthly income increases to about $308. That's a small bump now, but compounded over time, strong dividend growth could increase monthly income by $50–60 within a few years. Here's how to approach SCHD reconstitution. Stay calm and don't sell prematurely. The ETF aims to maintain high-quality dividend payers. Changes are usually improvements, not downgrades. Historical data shows that performance often stabilizes or improves after reconstitution. Monitor sector exposure. If energy drops, consider whether you need to rebalance elsewhere to maintain your desired sector allocation. Don't chase removed stocks. Being removed from SCHD doesn't automatically make a stock bad. It simply failed SCHD's quality criteria. Focus on your long-term strategy, not short-term index movements. Consider tax implications. While the ETF's buying and selling doesn't trigger taxes in taxable accounts, changes in dividend income can affect your tax planning. For example, a $500 increase in annual dividends adds roughly $75 in taxes at a 15% qualified dividend rate. Trust the process. SCHD has a long track record of consistent dividend growth since 2011, including through multiple reconstitutions. Its methodology works, and investors benefit from a disciplined, rules-based approach. To recap, SCHD reconstitution happens annually, targeting top 100 dividend-paying U.S. stocks based on strict quality criteria. Likely removals in 2026 are concentrated in energy and financials. Additions are expected in healthcare, industrials, and consumer staples, boosting long-term dividend growth. Short-term income changes will be small, but strong dividend growth could improve monthly income over the next few years. Investors should stay patient, monitor sector exposure, and avoid chasing removed stocks. The official reconstitution announcement will come in late February or early March 2026, so keep an eye out for updates. Knowing the rules and trends allows you to anticipate changes, plan your portfolio, and maximize your dividend growth over time. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.